Real estate made more millionaires than any other asset class in history. The S&P 500 has outperformed rental property returns in 7 of the last 10 decades. Both of those statements are true. Both of them are also incomplete. And the people who quote them are almost always trying to sell you something. This video does one thing. It runs every number honestly. The returns, the hidden costs, the tax advantages, the risks, and the one factor that almost every comparison gets completely wrong. By the end, there is a clear winner. But the winner depends on a condition most people never think to check first. Subscriber CTA number 1040. If you want financial breakdowns with real math and no agenda, subscribe right now. This channel covers the money decisions that actually move the needle. Hit subscribe before we get into the numbers. Setting the baseline. Let's start with $50,000. That is the investment. Same money, two paths. Path 1. You use that $50,000 as a 20% down payment on a $250,000 rental property. 30-year mortgage at 7%. Monthly payment of $1,330. You rent it out for $1,800 per month. Path 2. You put that same $50,000 into a total market index fund. You add $300 per month consistently. You do not touch it. Same starting capital. Same 20-year timeline. Let's see where both end up. The real estate numbers. On paper, the rental property looks like a cash flow machine. $1,800 rent minus $1,330 mortgage equals $470 per month. $5,640 per year. That is the number landlords quote at dinner parties. That is the number on every real estate investing thumbnail. Here is what comes out of that $470 before you see a dollar of it. Property taxes. Roughly $2,500 to $3,000 per year on a $250,000 property. Insurance. $1,200 to $1,500 annually. Maintenance and repairs. Budget 1% of property value per year minimum. That is $2,500 on a $250,000 house. Some years it is a $150 faucet. Other years it is a $9,000 roof. Vacancy. The average rental property sits empty roughly 1 month per year. That is $1,800 in lost income plus cleaning, relisting, and your time. Property management, if you hire out. 8 to 10% of monthly rent. Another $144 to $180 per month gone immediately. After every real cost. The actual net cash flow on a $250,000 rental property in a typical market lands between $100 and $300 per month. Not $470. And that does not count a single hour of your time coordinating repairs, screening tenants, or handling emergencies. Over 20 years, cumulative net cash flow after all real expenses runs approximately $24,000 to $72,000. But here is what real estate has that stocks do not. Leverage. You used $50,000 to control a $250,000 asset. At 3.5% average annual appreciation, that property is worth approximately $497,000 after 20 years. Your mortgage balance at that point is roughly $130,000. Your equity is approximately $367,000. Add the net cash flow and your total return on the original $50,000 investment is somewhere between $390,000 and $440,000 over 20 years. That is a powerful number. Leverage is the single biggest advantage real estate has. Full stop. Like CTA. If this is already showing you numbers the typical real estate versus stocks video skips, hit like right now. It takes 1 second, and it helps more people find this content. The index fund numbers. $50,000 into a total market index fund. $300 added every month. 10% average annual return, the historical average for the total U.S. market over any 20-year period. Year 5, approximately $115,000. Year 10, approximately $225,000. Year 15, approximately $390,000. Year 20, approximately $590,000 to $620,000. Zero tenants. Zero maintenance calls. Zero vacancy months. Zero weekends managing anything. Total contributions over 20 years. $122,000. The remaining $468,000 plus is pure compound growth. On raw numbers, the index fund wins. But raw numbers are not the whole story. The hidden advantages of real estate. There are 3 real estate advantages that almost never make it into the comparison, and they are significant. Depreciation. The IRS allows rental property owners to deduct the theoretical decline in their building's value from taxable income every single year. On a $250,000 property, that is roughly $7,270 annually in paper losses you can write off against real income. This is a tax shelter stock investors simply do not have access to. The 1031 exchange. When you sell a rental property, you can roll the entire profit into a new property and defer capital gains taxes indefinitely. Stock investors pay capital gains tax every time they sell. Forced appreciation. Unlike an index fund, you can directly increase a property's value through renovations, better management, or rezoning. The market sets your stock price. You have zero influence over it. These advantages are real. They are the reason sophisticated real estate investors can generate returns that exceed the index fund math on paper. The hidden costs nobody shows you. Now, the honest version of the real estate side that the investing gurus leave out. Liquidity risk. If you need $30,000 in an emergency, you can sell index fund shares in 48 hours. You cannot sell 12% of a house. Real estate is illiquid by design. That illiquidity has a real cost that never appears in return calculations. Concentration risk. Your index fund owns thousands of companies across every sector and country. Your rental property is one asset in one zip code. One bad neighborhood shift, one major employer leaving town, one zoning change, and your asset value drops with no diversification to cushion it. Time cost. Managing a rental property is a part-time job. Screening tenants, coordinating repairs, handling disputes, filing taxes with depreciation schedules. If you value your time at even $25 per hour and spend 5 hours per month managing, that is $1,500 per year in untracked cost that never appears in the return calculation. Leverage cuts both ways. In 2008, property values dropped 30% nationally and more in some markets. A leveraged property owner saw their equity wiped out or went underwater. A total market index investor saw a 37% drop too, but with no debt attached and no foreclosure risk. They just waited. The market recovered in 4 years. Some real estate markets took a decade. Capital expenditures are guaranteed. Roofs last 20 to 25 years. HVAC systems 15 to 20. Water heaters 10 to 12. These are not surprises. They are scheduled expenses that the cash flow math almost always ignores. A $12,000 roof replacement in year 18 is not a disaster. It is math you should have planned for from day one. The real comparison, 615. Here is the honest side-by-side after 20 years. Rental property total return on $50,000 invested. Approximately $390,000 to $440,000, including equity and net cash flow. Time invested. Estimated 5 to 10 hours per month for 20 years. Risk profile. Concentrated, leveraged, illiquid. Index fund total return on $50,000 plus $300 monthly. Approximately $590,000 to $620,000. Time invested. Near zero. Risk profile. Diversified, liquid, no debt. The index fund wins on total return in this comparison. It wins by a significant margin, and it wins with a fraction of the complexity, risk, and time. But here is the one variable that can flip this entire result. The variable that changes everything. The comparison above uses a typical rental market. Rent at 0.72% of purchase price. Average appreciation. Average vacancy. Change one number. Find a property where monthly rent is 1% or more of the purchase price. A $200,000 property renting for $2,000 per month. That ratio exists in real markets today. Midwest cities, smaller metros, specific neighborhoods in larger cities. At that rent-to-price ratio, the real cash flow after all expenses is no longer $100 to $300 per month. It is $400 to $600 per month. The leverage still applies. The depreciation still applies. The 1031 exchange still applies. At 1% rent-to-price ratio with leverage, real estate can match or beat the index fund over 20 years. And when you combine both strategies, real estate providing leverage depreciation and cash flow, index funds providing diversification and liquidity, the combined return over 20 years beats either one alone. The winner. Here is the honest answer. For most people, in most markets, with a typical rental property, the total stock market index fund builds more wealth over 20 years with less risk, less time, and less complexity. The index fund is the winner for the average investor. But real estate wins clearly under three specific conditions. 1. You find a property at or above 1% rent-to-price ratio. 2. You treat it as a real business with real systems, not a passive income fantasy. 3. You use the tax advantages, depreciation, and 1031 exchanges strategically. If those three conditions are not met, you are not investing in real estate. You are buying yourself a second job that pays less than minimum wage and calls you at midnight about a broken furnace. The stock market does not call you at midnight. It does not need a new roof. It does not have bad tenants. And over 20 years with consistent contributions, it quietly builds more wealth than most people expect from something that requires absolutely nothing from them. Do both if you can. But if you can only choose one, choose the one that works while you sleep. Final CTA. If this gave you a clearer picture of how these two investments actually compare, not the thumbnail version, but the real version, hit like before you go. Real numbers. No agenda. No fluff. And drop a comment below. Are you team real estate, team stocks, or are you doing both? I read every single one. See you in the next one.